Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
But one of the problems we see, and we continue, and it hasn't caught up yet, is sooner or later the real economy, where we live and work, real jobs, real savings, building real plant equipment, versus the financial economy. The financial economy is still very happy getting all that juice pumped into the balance sheets of all these financial institutions that should have been allowed to maybe either go belly up or default and just clean. That's a whole nother seminar in itself, but you still haven't seen the real economy catch up to what these asset prices seem to imply. As we know, stocks and financial assets always lead the real economy, but we're just not seeing any improvement in the real economy to support the relative valuations we're seeing in the financial economy, and that has us very concerned. Two, as I said, the dollar is a global liquidity fuel. And that's basically market manipulation of your currency by Ben Bernanke and the Fed. They're just doing it implicitly through all this money thrown out there, and yet they're going to turn around and complain about everybody else in the world manipulating their currency. So everybody's playing this game. We're doing it just another way. And the secondary or underlying problem with the monetary system that's based on the U.S. dollar in general, it almost leads a bit to this situation. When the world gets in trouble and there's no demand out there, the Federal Reserve is basically the de facto central bank for the global economy because the U.S. dollar is the world reserve currency. Most things are U.S. dollar-based credit for transactions, major capital transactions, major commodities transaction. It is the dollar. There was this economist named Triffin, and it's referred to as Triffin's dilemma. He talked about this in 1959. He said if the U.S. Dollar takes over the role as world reserve currency in the place of gold, they're going to lock themselves in the current account deficits for a long time because the dollar has to be the fuel to power the global recovery. And it's a very interesting thing that we're now stuck in a situation, and it's so palpable that the U.S. Fed is moving money offshore to keep offshore markets alive, even though the U.S. economy isn't rebounding. And as we do this, we weaken the U.S. balance sheet even further and weaken our own currency further, and basically make our consumers and the U.S.-based consumer that uses the dollar as a store of wealth makes us poor, so to speak. So it's a very, very odd situation that we have ourselves in. And so the question is, does QE2 work when QE1 didn't? And as I said earlier, part of the problem is, and the Japanese even warned the Fed about this about 4 or 5 years ago. The bank, some of the heads of the Bank of Japan told the Fed, don't get close to a zero rate situation, you will come to regret it. And they specifically said, once you get into a zero interest rate situation, the money market doesn't work. The transmission mechanism that moves money from the banking institutions to the real economy, is what we just talked about, and we're seeing that dislocation. The banking institution, when they have no incentive to lend this money to other banks that may have real market opportunities, when they have no incentive to do that with zero interest rates basically in the interbank market, the money just sits on the balance sheets of these banks, and it seems to be a quagmire that we've gotten ourselves into. There's an economist at Stanford, McKinney, who did a paper on this a couple years ago, and it's been right on the money. And we're into that situation, and this is part of the reason that QE2 is not going to have the impact that it should have, and that's why QE1 didn't. Interest rates are so low, so money just sits in the financial economy and doesn't get to the real economy to create that demand that the world needs. The world needs demand for all these exporters to export something too, and if that doesn't happen, these currency wars continue until something breaks in a very, very big way called a trade war. So what's happened with the U.S. pumping all this money out, Bank of Japan pumping all this money in, Bank of England, European central banks? It's creating two worlds effectively. We're in the developed world economies, the industrialized world, we're in a world of deflation, and part of this process is to try and reflate. But interestingly, it's doing nothing but inflating the emerging market economies, developed world economies, because of the free capital flows, obviously. Investors here are taking this money and moving out here for yield and growth. So we're not seeing a rebound in consumer demand. We're not seeing a rebound in jobs at all in the developed world economies, and yet the emerging market economies are blowing and going just directly from all this liquidity fuel coming from the center again. Remember the center periphery. Since these guys still don't have their own capital markets, and everybody's fat, dumb, and happy about everything that's going on in the emerging markets and not looking at it as a liquidity bubble being thrown in from the developed world side of the fence, we think it's getting very, very dangerous out there in emerging markets, and we could have obviously a major dislocation again if demand doesn't rebound in the major economies in the world. Because when we have the major dislocation, this money just goes back into the reverse. Money goes from the periphery risky assets back to the center, and that's why the U.S. dollar tends to do well when you have very, very ugly times. All this dollar-based credit thrown out here, people say, well, they're not going to get it anymore because of the problems at the center. Problems at the center mean the banks that have made all this lending out, consumers that have made this lending out to the periphery countries say, I want that money back because I have problems, not because of anything here. Growth opportunities may still be there, but the fact is they're liquidity driven and they don't have their own domestic source of capital to sustain this. Money flows back the other way, and we're back into that situation. And this was part of what the credit crunch was about. And the scary part, as I said, is that the imbalances have gotten worse. So as this money pours into the emerging markets for growth and yield, which makes sense. I mean, if you're an investor and you look at what's available to you in the U.S. From a yield standpoint and the relative growth of the U.S. economy compared to what's going on out there in Singapore, Malaysia, Indonesia, China, South Korea, you're moving your money out there. Brazil, you're getting paid high yields, and those markets are growing. So it's leading to a self-reinforcing boom in liquidity to these areas. So the self-reinforcing boom in liquidity naturally pushes up the currency values of these emerging markets, which have to compete against who? China, to sell stuff to the West, even though the Western demand is not where it was before. So you have a lot of liquidity going in here into the emerging markets, even though the relative export potential has declined from where it was in the past. So this is another reason why we say this is very much a liquidity-driven bubble to a large degree, and not that there aren't real fundamental reasons, but fundamentals are ephemeral, and they can change as quickly as technicals in any dislocation. And the dislocation problem that we see is any spat really in a big way between China and the West, the U.S. primarily, when it comes to trade. So in effect, all this money going out and the fact that China's currency is relatively fixed means it's helping and hurting China. In one sense, as the U.S. pushes down the value of the dollar, the relative value of the Chinese currency goes down against its major competitors. So think about it this way. As China takes all those massive FX reserves that it gets from surpluses, it gets from the money going out into China in general, and it creates, because of the fact that it has to create these reserves to keep its currency suppressed, it now has 2.65 trillion with a T in foreign exchange reserves. It's the highest it's ever been. That's another example or another indication that global rebalancing isn't taking place. If it were taking place, this reserve balance would have declined, not increased, but it's increasing very, very quickly again.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.